All right, welcome back. Today, we're going to tackle something that's, well, pretty powerful. We're going to learn how to read the secret language of the financial markets. We're going to take what looks like a bunch of random noise on a screen and turn it into a clear story about buyers, sellers, and what the big money is really doing. So let's just dive right in. You ever look at a price chart and it just seems impossibly complex, like some kind of uncrackable code? Well, it's not. It's actually a language. And today, I'm going to give you the keys to unlock it. We're not just going to look at what the patterns are, we're going to dig into why they work. Every language has to start with an alphabet. And in the market, our alphabet is made of candlesticks. You got to think of each individual candle as a single word. It tells us the story of the battle between buyers and sellers over a specific slice of time. It's our very first clue about what's really going on. So let's start with a really powerful word, the bullish engulfing pattern. Picture this. The price is trending down. You see a small bearish candle, and then bam, a massive bullish candle comes out of nowhere and completely swallows the previous one. Now, this isn't just a little bounce. It's a statement. It's a sudden, almost violent shift in momentum that tells you buyers just took complete control from the sellers. But listen, this is what separates the amateurs from the pros. A pattern, all by itself, is pretty much useless. The most important thing is context. Where this pattern appears is everything. If you see it at a key support level or during a pullback in a solid uptrend, that's powerful. But if you spot that same pattern in the middle of a brutal downtrend, yeah, that's probably a trap. Just a brief pause before the next drop. Let's see how this plays out in the real world. So imagine the euro has been climbing, and it pulls back to a key moving average, which is basically a moving support level. It kind of stalls out, and then it prints that huge bullish engulfing candle. You see, that's not just a random pattern. That's the market confirming that the original uptrend is very likely ready to take off again. Okay, now let's flip the script and look at the opposite. It's called the shooting star. This candle tells a story of complete failure. The buyers tried. They really did. They pushed the price way up, and that's what creates that long upper wick. But then the sellers stepped in with so much force, they just slammed the price right back down. It's a crystal clear sign of a powerful rejection from higher prices. And just like before, context is king. A shooting star means the most after a long rally, right up into a known resistance area where you'd expect big institutions to be waiting to sell. But if you see one pop up during a fresh breakout that has a ton of momentum, it might just be a little pullback, not a full-blown reversal. Here's a perfect example for you. Let's say gold has been on an absolute tear, and it runs up to a major psychological level, like $2,050. It tries to push even higher, but it gets smacked down, forming a shooting star. This isn't just some random candle. It's a huge, flashing signal that sellers are aggressively defending that price zone. So, we've learned a few words. Now it's time to learn the grammar. This is where we start to think like the big institutions, what some people call the smart money. See, they don't just react to price. A lot of the time, they're the ones creating the moves that form the patterns we see. Let's talk about one of their classic moves, the liquidity sweep, also known as a stop hunt. Now, you've probably heard people call this market manipulation, but let's try to reframe that. It's really just a calculated business move. Think about it. If you need to buy 1 million shares, you can't just click a button. You need sellers. And where's a place you can find a ton of sudden sell orders? Right below recent lows. Exactly where everybody puts their stop losses. So here's how the trap gets set. Step 1. Regular traders place their stop losses at an obvious, totally predictable level. Step 2. The price is deliberately driven down to that exact level to trigger all of those sell orders. Step 3. As that flood of selling hits the market, the institutions are waiting on the other side, quietly buying up everything to fill their huge orders. And finally, Step 4. Once their positions are filled, the price sharply reverses, leaving everyone else stuck on the wrong side. Check out this other example. The euro hits the same high 3 times in a row, building up a massive pool of buy-stop orders just sitting there. Then, the price intentionally spikes up just enough to trigger all those stops, and then it immediately rejects with a huge bearish candle. That spike wasn't a real breakout. That was the signal that the institutions just filled their short positions. Okay, so we've got the alphabet, and we've got the grammar. Now, it's time to actually write the story. And this is honestly the most crucial part of everything we're talking about today. It's called confluence. It's the art of combining multiple, separate signals that are all pointing to the exact same conclusion. Please remember this. A single candlestick pattern or a single indicator reading It's just noise. Statistically, it's pretty much insignificant. A professional trader builds a case. They build a narrative. They layer different pieces of evidence on top of each other until the story the chart is telling becomes undeniable. So how do they actually do it? Well, with a framework, something like this. It's a top-down approach. You start with the big picture, the why. What's the overall trend? Then you zoom in to find where you want to take action, a key price level. And only then do you wait for the when, your specific entry trigger. Finally, you verify it all with confirmation and, this is the most important part, you define exactly where you're wrong before you even get in. Okay, let's actually walk through building a trade with this framework. We'll use gold as an example. Step 1, the why. We look at the fundamental backdrop, and we see that things are looking good for gold. Maybe real interest rates are falling, geopolitical risk is high. Whatever the reason, our overall directional bias is now bullish. We are only looking for reasons to buy. Step 2, the where. We look at the daily chart, and yep, gold is in a clear uptrend. Now, it's pulled back to what we'd call a high probability demand zone. That's an area where institutions have bought heavily before. And if we look even closer, there's a price imbalance or a fair value gap in that same zone. That's just an area where price moved so fast it left an inefficiency. So now we've got multiple factors pointing to this specific area as a place to pay attention. And now for the final pieces of the puzzle, the when. Price dips into our zone, and what does it do? It performs that liquidity sweep we just talked about, dipping below a low to take out the weak hands. Then it immediately reverses higher with our trigger, that powerful bullish engulfing candle. For confirmation, we might see the RSI showing bullish divergence and maybe a massive spike in volume. The story is complete. We have a solid case. So what have we really learned here today? We've learned to see the market not as just a bunch of random patterns, but as a strategic environment. And that requires one final, really crucial shift in your mindset. And this right here is the ultimate takeaway. Your job is not to be a fortune teller. It's to be a risk manager. It's all about using confluence to find those specific moments where the odds are well and truly stacked in your favor, and then having the discipline to act. That is how you go from just reading a chart to truly understanding the story it's telling you.